Hello, everyone. Welcome to Cleaves Shipping webinar. We're so happy that so many wanted to watch our first webinar. Today, Joakim will start to go through the shipping quarterly report, which you can download for free at our website, cleaves.no. And after that, we will have a Q&A session. And while he's going through the report, you can ask questions in the Q&A tab that you can see at the bottom of the screen. And if you see that someone asked a question that you also wondering about, then you can like the question. And at the end, I will prioritize the questions with the most likes. Yeah, otherwise, if there's anything, ask in the chat. Now, let's get to it, or what?
Yes. Should we share the presentation?
Yes.
So we will, just to give you a brief overview, we will start with going through each our covered shipping segment. So we'll start with dry bulk, which is our topic within the shipping universe. We will then go through oil tankers, where we see some potential trading gains being made over the next few months, but a cyclical trough expected in the third quarter of next year. For LNG carriers, we are in the midst of a strong fourth quarter. We think some gains can be made here in the short term, but we see prolonged weakness for the segment over the next few years. For LPG carriers, then mainly VLGCs, we see some slight headwinds over the next few months and potentially also in 2021. But then for 2022, we see a strong market for a couple of years. And then we will wrap it up with our top stock picks and a Q&A session at the end. So for dry bulk, looking at the short term, our kind of to take the negative first, our main concern at the moment and the main negative sentiment comes from Chinese ban on Australian coal imports. So to give you kind of the numbers, around 40% of Chinese coal imports comes from Australia. But around only 2% of total Chinese coal consumption comes from Australian coal imports. So it's a very small part of total coal consumption in China. So that makes it easy for China to ban this small portion. I personally believe it's two reasons behind it. It's one is the political motivated reasons. And then, as we have seen in the two prior years, they have worked to curb coal imports in the fourth quarter to support domestic producers. So this could be a part of that strategy, just aimed 100% towards Australia this time around. So the big question is then what will happen when we come into 2021? Will the coal ban persist? And in the worst case scenario, we estimate around 1.2% of the total dry bulk demand growth, or the total demand for dry bulk shipping is this individual trade between Australia and China on coal. So all else equal, if we remove that 1.2%, our Capesize forecast falls from $22,000 a day on average for 2021 to $18,000 a day. We do, of course, believe there will be mitigating factors such as Australian coal finding other homes, importers potentially further afield, increasing the average sailing distance. So it's not black and white, but that's at least the numbers for you, a rundown on the worst case scenario, and we will follow the story as it develops. The positive thing is looking at Brazil or Chinese iron ore imports from Australia. It's a very big portion of their total consumption. So we don't expect Chinese authorities to do anything similar with Australian iron ore imports as they have done with the coal imports. So iron ore is a very positive story at the moment. with Chinese steel production reaching all-time highs this year. We have seen a large increase in activity in China after the COVID-19 outbreak was subdued, and they are adding fiscal stimuli and they are adding stimuli to infrastructure projects. So obviously all these stimuli are highly geared towards commodity-driven production, needing iron ore, coal, and so on. Against that backdrop, we are watching Brazilian iron ore exports quite closely. They had this dam collapse in January 2019. So after that, Brazilian iron ore exports have struggled to reach back to normalized levels. Very positively, we saw Brazilian iron ore exports close to all-time highs in September. We do feel and see that we are reaching back to normalized levels for Brazilian iron ore exports. And that is obviously supporting the relatively strong earnings we have seen for Capesizes after summer. Of course, it's highly volatile, but we view volatility as a sign that the fleet utilization is tightening. And so it's a positive sign when you get this kind of volatility, even though we might wait until 2021 and 22 to see substantially higher rates. So just looking at the very short term, we do see some seasonal headwinds. I would expect spot rates to stay elevated until maybe the 10th or the 15th of December. And then you usually have seasonal factors coming in. We have Chinese New Year, as you can see in the graph on the lower right corner. This is kind of an interesting graph, and the correlation and the persistency of this relationship is quite strong looking at history. So 8 weeks prior to Chinese New Year's, spot rates tend to fall and then potentially rise again into 8 weeks after. And Chinese New Year is 12th of February this year. So I think mid-December is a good guesstimate on when spot rates could start falling. It's usually, or if you do the correlations on a quarterly basis, share prices is not correlated with seasonality at all. But obviously, if you get a big drop in spot prices, you can see daily spot share pool movements on the negative side. But that could be a potential buy opportunity for the longer duration. So looking at the longer term for dry bulk shipping, one of the key factors behind our optimism towards the segment is the order book, which is now only 6.5% of the fleet. That's the lowest level on record, and our records go back to 1996. So based on that record low order book, we see only 1 to 2% net fleet growth in the coming years. And also, when you see both in dry bulk and also oil tankers, you see periods with strong earnings. There is not a big pickup in newbuilding contracting. So this leaves us highly optimistic towards also that the middle of this decade could be strong. Usually we take 2 years to deliver a vessel. And usually when you get an uptick, people order and you kind of get a cyclicality with a 2.5 year lag. But this time around, we are optimistic that the new regulations and uncertainty around new technology will continue to kind of lead to underinvestment in both dry bulk, oil tankers, and also LPG segment. So with that backdrop, it takes very little demand growth to improve fleet utilization. And we expect or we forecast for 7% growth year over year in 2021 on the demand side. And that's mainly a catch-up effect of the very weak or the negative demand growth of the first half of this year. And thereafter, we're quite conservative in our demand growth forecast. So we think steel production in China will plateau. We think there will be a positive substitution effect from higher quality iron ore and coal imports substituting domestic produce. So we will have some growth despite steel production plateauing, and also some growth in grains and other minor bulks. But it's basically the low order book, which is the main reason why we're so optimistic for the future. No, please, next slide. Thank you. So fleet utilization is thus expected to slowly grow step by step over the next few years. It's we often get this kind of elasticity which is higher than our forecast, but our forecast is for a gradual growth, and then we wouldn't be surprised if 1 year surprises on the upside and we kind of get the market moving even faster. But even with our conservative forecast, we see our dry bulk asset index up 40% over the next year and potentially 60% over the next 2 years. So that sounds like big numbers, obviously, but if you look to the lower left corner of the graph there, kind of puts this in a historical context. Yeah, it's a big percentage number, but it only takes us back to the levels we saw back in 2013, and we are still miles away from asset prices back in the super cycle of 07, 08. So and kind of tying this into our dry bulk share index model, we see that the index could potentially rally 123% over the next year and 186% over 2 years. And I also would like to point out the conservatism here. If you look at the graph on the lower right, you're going to see the thick gray is our forecast, but our share index model is actually predicting a potential 300% increase in the share index based on historical patterns. But we have decided to be a bit more conservative, looking towards the 2017-18 cycle as guidance. So still, we are very optimistic towards dry bulk. So moving on to oil tankers. So for the short-term outlook, it's interesting to see how much floating storage there still is. So as many of you maybe caught up on, during this spring, we saw oil prices collapse, overproduction, and a steep contango in the oil price futures curve. And this led to a massive increase in floating storage, peaking around 12% of the total fleet in this spring, and it's still quite high at 8%. So we expect this number to fall towards 3% moving into 2021 and 22. Also interesting is to see the VLCCs are keeping up at pretty much a stable level since the peak in this spring. It's more the smaller vessel classes which are coming off floating storage. So against that backdrop, one would expect that spot rates were quite high, and the fleet inefficiency will play into the hands of the owners. But the problem here is obviously that oil supply has fallen dramatically. You can see the graph with the OPEC crude oil exports from the Arabian Gulf. So you kind of see the spike we had back in April when OPEC Plus entered into a price war. Then VLCC spot rates peaked around $300,000 a day, and then the collapse as they came to an agreement. This is not just for OPEC exports from Arabian Gulf. This is also for other OPEC Plus exporters and US exports to a certain degree, and also other exporters. So we kind of have floating storage supporting, but then obviously supply is decimating the demand for oil tankers. So looking at the seasonality graph to the lower right corner, you can kind of see where we are right now. Depending on which trade route and which vessel class you're looking at, we are around operational costs. And this is in a period where we are usually seeing strong seasonality improvements. Our forecast is obviously for a muted winter market, usually lasting from around October to February. So we believe it's going to be very muted versus a normal year. But we still see some our VLCC spot rates potentially peaking around $30,000 a day over the next few months. So there is scope for some improvements and then potentially some trading to be done in the shares. But we haven't yet to see any improvements in neither the physical nor the forward market at the moment. So the longer term, I think it's a much more positive picture. Also here we have a very low order book compared to the fleet. It's now only 7.9%, and that's the lowest level since December 1996. So that again leaves us with only 1 to 2% fleet growth over the next few years, and that's pretty much exceptional. And so that means we need very little demand growth to kind of propel this market into better earnings environment. But will that come? The question is there. We forecast 2021 to be very challenging for oil tankers. You kind of on the lower left you see the oil supply and demand on a global basis. So you kind of see the disruption which happened here earlier this year, and then you see our forecast going forward. So we believe now we have entered the destocking territory. So we are now net destocking the oil inventories. And that's usually very painful for oil tanker demand, as you can see in the graph on the lower right. And we think that a period of net destocking will persist until the end of 2021. And then for 2022, we expect stocking to be neutral for oil tankers. So we will have low supply and a net destocking cycle in 2021. So any potential short-term improvements in earnings this winter market we expect to be very short-lived, and we expect the third quarter of next year to mark the cyclical trough for this market. So as you can see, then putting it all together, we have fleet utilization, which is, it was around 100% this spring, or as high as it's feasible to go. Now we are around 80%, and we expect 2021 to kind of average around 80%. And then from the third quarter, we expect the fourth quarter 2021 to show some more seasonality into the first quarter of 2022 versus what we expect this year. And that will, for our asset index on oil tankers, mean we still see around 7% downside on average asset prices into the third quarter. And then potentially beyond that, we see a 62% upside by year end 2023. And putting our share index on oil tankers into the equation, we see a potential 15% decline from yesterday's close until the third quarter 2021, and then potentially a massive 210% rally from that point until 2024. So it's kind of a two-faced investment advice here. We do see some weakness ahead, but still the long run is really looking good based on the low order book. So we would use any potential weaknesses over the next maybe first quarter, second quarter, third quarter 2021 to buy shares opportunistically. All right, moving on to LNG shipping. The short-term outlook here is now really kicking into life. We have earlier talked, or at least written in our reports about La Nina, I think it's basically confirmed we are in La Nina weather pattern this year. So this is positive for colder weather in the Northeast Asian region, Japan, Korea, northeastern China, and also northwestern parts of the North American continent. So that is likely to drive demand for natural gas consumption, especially for heating. And we have seen over the past 2 months a surge in natural gas prices at the major importers. And we have seen a significant widening in the regional natural gas price differentials. By that we mean US prices then as an exporter, and compare that to Japanese and Korean prices as an importer. So we have graphed that on the right, and we also added the LNG spot rates on top, kind of to visualize how important this is for LNG spot rates. So back in the middle of this year, we saw around 45 cargo cancellations each month out of the US because there were no economics in exporting the gas to the importers. Now we expect around, or from what we hear, we see around 5 cargo cancellations in November and down to 0 in December. So that means, and that's basically a consequence of the economics in transportation at the moment. And LNG carrier spot rates are surging. That graph could potentially imply we have hit the peak, but looking back to the last year, we see LNG spot rates kind of disconnecting from that correlation in the graph. So we still see some upside potential, but the coming weeks will be very interesting. Beyond that, looking at global energy exports, we do see both volumes and average miles per cubic meter transported increasing. So we do expect 12% demand growth in 2021. But against that, we have 9% fleet growth. So we only see a marginal increase in fleet utilization from 79% in 2020 to 81% in 21, and then falling back to 79% in 2022 again. So we expect some weakness after this fourth quarter. Yes, thanks. So if you look to gross vessel deliveries, so in 2021, I mentioned 9% fleet growth. And for 2021, we expect to see gross deliveries before scrapping and cancellations and slippage and so on at all-time highs. And we expect gross deliveries to be persistently at elevated levels going forward. So given the size of the fleet, that leads us with relative fleet growth similar to the past 6 years. So that doesn't sound too much, but over the past 6 years, we have seen quite good demand growth. So the question is, will we see good demand growth going forward into the next few years as well? And our answer to that question is no after 2021. So when you look at new liquefaction capacity coming online in the lower left graph, you see 2020 we have some new capacity coming online. 2021 almost 0, and the reason we expect demand growth to be that strong in 2021 is not because we get new capacity, but because we are utilizing that existing capacity more efficient. So into 2022 and 2023 also there's almost no new liquefaction capacity expected to come online. And we also added the orange dot or lines you can see in the graph. That was the forecast from January before the coronavirus outbreak. So you can really kind of see how much this has impacted the investment decisions. So people are constructing what's under construction comes online, but you can see all the investment decisions and also engineering processes being postponed. But that's a key issue here. We have not lost any expected capacity coming online. It's just been skewed into the latter parts of this decade. So that's one of the reasons we were optimistic before, but we're now even more optimistic that towards the latter parts of this decade, from 2024-25, we could see an enormous growth in demand for LNG carriers. Often you get a lot of new building orderings going along with those projects. So we will carefully monitor the order book, but I do expect a lot of spot activity would be driven also by all this new capacity coming online, which will be positive for speculative ordering or the lack of. So yeah, putting it all together, I basically kind of wrapped that up already. We do see improvements from 2024 into 2025. We have our high case here, which you kind of see the graph going off the chart in 2025. And that is if you have under ordering towards these projects. That would then lead to a super cycle. It's our high case at the moment, but our base case is still for very strong spot rates from 2024 and into 2025. Okay, moving on to LPG shipping. So this is basically focusing on VLGCs, the large gas carriers. So just a brief kind of history to explain the dynamics here. It's, the market dynamics is a bit, or has been in this particular period, a bit different from other shipping markets. So back in 2014-15, we saw infrastructural bottlenecks in the US. So they had a lot of trapped gas byproduct of natural gas production and the shale oil and gas production, and also refineries. So we had trapped gas, and usually you can't flare it because there's environmental restrictions. And at one point, as a curiosity, I think the prices in Canada went negative. So we had trapped gas, and they were working on putting together new terminal capacity. We also had a lack of shipping capacity. So these two elements caused the price differential between the US and import markets in Europe and the Far East to be high, because they were disconnected. And also because the lack of shipping, we saw shippers being able to capture close to 100% of that price differential, that arbitrage, one could call it. So that was happy times for shippers. Then moving into 2016 and until start of 2019, we saw a lot of new US terminal capacity coming online, and we also saw the VLGC fleet grew almost double in size. So then you kind of got the US, the Far East, the European markets connected together. So you basically had pipelines and no infrastructural bottlenecks. So that, and then you saw earnings close to operational costs for VLGCs. And then moving into 2019, we saw capacity on US export terminals moving back towards 100%. But you still had some leeway on shipping, so you saw a big increase in the price differentials. But VLGC owners weren't able to capture that 100%, so the correlation is less one-to-one in that period. So if you move on to the next slide, with that context, for US LPG exports, we expect exports to fall year over year next year for the first time basically on history, and especially since US became a significant LPG exporter around 2010. To the lower left, you see the US terminal utilization. So here you kind of see how much utilization of those terminals we just spoke about have been historically. So you saw we reached around 100% in 2019, and we expect that number to come down towards 60% in 2021. And we also have a lot of shipping available. So we expect those two factors to weigh on shipping moving into next year. That said, we do see some increased exports out of the Arabian Gulf and other sources, that being a kind of a catch up from COVID-19. So it's overall we see 2% demand growth for next year. So kind of summing it up for VLGCs, fleet utilization is then expected to stay fairly strong going forward with a fairly balanced supply and demand picture. Only 2 to 4% fleet growth is fairly low. So we only need, in a historical context, quite low demand growth numbers to exceed that fleet growth. But we still expect 2021 to be relatively weak, as US exports is basically the main driver behind rising demand growth for VLGCs. But we do see consecutive annual gains thereafter. So we expect VLGC spot rates to be volatile, and we also expect, kind of putting it together with our VLGC share index, we expect that index potentially to decline 28% going into the first quarter of 2021 in concert with potentially falling spot rates. But then thereafter we could see a potential 140% rally by year end 2022. So what we see is weak Q1 2021, weak Q1 2022, and thereafter we see strong gains. All right. We have then reached our top stock picks.
I bet many is wondering about this one.
Hopefully. And hopefully we will give you some good advice. We just put together on the top right our share indexes going forward. So you kind of see where we are now, indexed to 100. For dry bulk, it's a bit linear, so it's always very challenging to predict kind of when things will happen. We might argue that Q1 might see a dip because of seasonal headwinds, but we do expect strong improvements for dry bulk share prices going forward. For oil tankers, it's a slightly up during the winter market, slightly down for the third quarter, and then strong gains thereafter. And for VLGCs, some headwinds in the short term, and then some gains moving into 2022. So against that backdrop, for dry bulk, our topic within our shipping universe, within that segment, our topics are 2020 bulkers, Diana Shipping, Genco, Golden Ocean, and Star Bulk. So for oil tankers, for the less risk-averse investors, we do potentially see some trading gains could be made over the next few months, trading on spot movements and so on. It's very risky, but we view DHT, Euronav, Frontline, and TK as good instruments to play it in that way. But our general recommendation is to kind of wait and then opportunistically buy hopefully cheaper shares during the second and third quarter of next year. For LNG, FLNGs or Flex LNG is basically the main investable share in our opinion. It's highly undervalued, but it has been so for a long while. So it's hard to say if and when we will see parity to NAV again. But they have a modern fleet and they're doing a lot of the right things, and they have a good exposure towards the current spot rate environment. So to kind of wrap it up on the stock picks, I think for VLGCs, even though we see downside in our share index in the near term, it's very risky shorting these shares. They're so volatile. So I think our recommendation should be to just buy opportunistically on weakness over the next half year, and then see and wait for the improvements from 2022. So just summing it up, the last slide. Dry bulk, we are positive. We think there's a lot of way to go in that cyclical expansion. We think it could potentially last until at least 2023, potentially 2025. It will likely be slow and steady with gains along the way. And then for the hydrocarbon transporters, we see LPG carriers coming off the cyclical expansion and into a cyclical trough. We think that cyclical trough will be short-lived. And then for LNG carriers, we do think that cyclical trough will be more prolonged, potentially several years. And for oil tankers, similar to LPG, it will likely be short-lived due to the low order book. So I think with all that said, I'm happy to open the floor for any questions we might have.
Yes, we have a lot of questions here. Let me have a look. So here's a question. Will uncertainty around shipping emission regulation suppress new build orders for all type of vessels in the years ahead?
Yes. So I think that's the right assumption to make. I think we should view it in a slightly broader context. I think the lower emission is kind of the aim, but I think we will have to look at what's happening in between there. So we now this year had in the introduction of IMO 2020 capping sulfur emissions. So that was a long process before we ended up there, and I think the industry has handled it quite well. All the talk now is what will be the next fuel? Could we potentially use LNG, LPG? People are already talking about ammonia. I think there's a lot of at least the last one, which has by many been put forward as a solution for 2030. I think there's a long way to go to both on the technology side and also on the economic side. We need to keep the costs down in the process. So right now, I think we will still have a period where people are uncertain. We don't have the regulations in place, and we don't have visibility on neither the regulations nor the technology. And I basically think the 2020s could be one of the best decades in shipping for a long time, based on our continued underinvestment.
Yeah. So this is related to the top-rated question here. Yeah. Which is what are their assumptions around scrapping for tanker supply, net fleet growth, given 1 in 4 VLCCs are older than 15 years old. Cleaves forecast for 2021 to be tough for tankers. Are we assuming a lot more scrapping from now till Q3 2021, or? Yeah, so for yes, we are forecasting for an elevated level of scrapping going forward. So how we model scrapping, we look at the spot rates, we look at the demolition price, we look at the age profile of the fleet, and so looking at earnings, that's kind of what's propelling our elevated scrapping forecast going forward. When we look at asset prices versus scrap prices, so when we had a lot of scrapping in 2017-18, we had a 15-year-old VLCC trading very close to the scrap price. But then back then the VLCC price were lower, and the steel prices and demolition prices were higher. So, and that kind of induces a lot of scrapping when the opportunity cost
of trading further going through special surveys versus scrapping when you have only a few dollars in between. Then it makes sense to scrap. So that's a really strong force, and unfortunately we are a bit away from that tightness in those parameters at the moment. But still, we think we will have an elevated scrapping given that earnings will be low, and also after the introduction of IMO 2020, it costs relatively much more to operate an older vessel than a new one.
Yeah. So we have a few questions on China here. Let's start with the top-rated one. What's the risk that China's government will build a substantial fleet of new oil tankers to ensure not being hostage to a potential tanker shortage in 22, 23, maybe it should say 24, and by the same token gain market share and more control over the global energy markets?
Yeah, I think that's a tough question because what Chinese authorities do, it's basically decided within a small group of people, which and they unfortunately are not allowing me into that room to listen.
No,
Not
even you.
I haven't asked, but maybe. So that means I personally can't really make any predictions around that. But what we have seen is they already have a big fleet of tankers. They have a big fleet of dry bulk vessels. So they're obviously managing the balance between controlling vessels for importing the commodities, which they are highly dependent on, and also kind of making the market dynamic enough so they can benefit from fluctuations. Like we saw this year, the big imports of crude oil they undertook when the prices were low, and also we do see the U.S. sanctioning Chinese owned shipping, so it's not really a straightforward solution, all depending on how the trade environment will develop in the coming years. So I think it's a tricky question, and I can't really say I have a straightforward answer to it.
Yeah, there's another question on China here, which is when will you adjust your targets if China also bans the import of Australian coking coal in 2021?
So if they ban coking coal, I mean that's already included in that 1.2% lost demand I mentioned earlier in the presentation. So if all coal imports from Australia is banned, it represents around 1.2% of all dry bulk demand on a ton mile basis, and that leaves our Capesize forecast lower by 4,000 from 22 to 18, all else equal, but you will have mitigating factors from maybe they will export it to South Korea or Japan or Europe instead.
Okay, moving over to LPG. There's the questions here. We have seen relatively little activity in the period charter market. The big three VLGC owners, Avance, BV, LPG, and Dorian, only have a few vessels on longer term charters. What do you think is the reason for this, and will it change? I.e., will we see VLGC owners seeking to put more vessels on long-term charters?
Yeah, I mean, given my view, I would definitely balance to have a portfolio perspective on managing the fleet. So I would personally fix out for 1 to 2 years. It's hard to say why the owners haven't done it. From what I can see, I think BV LPG has had a market view quite similar to ours, and also BV LPG has a percentage of their fleet on contract of affreightments, so they have some coverage there, at least on the utilization level. I can't really answer on behalf of Avance and Dorian LPG, but personally, I would have a portfolio approach and be pragmatic towards potential fluctuations we could see in 2021.
Okay, VLGC rates have been very unpredictable in the last year. Given this, can you have a high level of confidence in your rate forecast going forward?
That's a good question, and the answer is no. We can't have. We strive to have conviction, and we do have conviction, but it's to give you an example from the third quarter. Obviously, we missed the demand growth and then spot rate forecast for the third quarter of this year, and that's luckily that was quite an unusual event. So I spent a lot of time going through the model, understanding in detail, obviously why, and what happened. The interesting part was that we expected for a 13.5% demand contraction quarter over quarter, if I remember correctly. And when I took, that was based on our forecast for exports from the US, AG, and all those regions. And when I kind of took the actual numbers and plugged that into the model, it gave 13.0%. So obviously it wasn't the demand side of our model which was disconnected. And then digging further into it, I kind of found out that a lot of the vessels went through or around Cape of Good Hope, and they slow steamed, and we had congestion in Chinese ports. So all these factors kind of colluded together on the fleet efficiency side. So that was the major reason why we missed that Q3. And back to the question, if we kind of have confidence going forward, we have conviction, I would say, with a confidence interval, which is at the moment wider than it usually is. Our model has been working very well since 2014. I haven't really changed it at all since then, but we made some minor changes now to better capture this kind of intra-Q volatility we see. So hopefully we will hit the mark better going forward.
Okay, thank you. Yeah, there's also a lot of people writing thank you for sharing your knowledge. So you should know that.
I appreciate that. Thank you.
Flex LNG has the newest fleet among the publicly listed LNG shipping companies. But how does Flex compare to the private companies? Do you know that?
It's a good question. So the private companies, I'm just thinking, I guess we are then talking about the likes of Cardiff and so on.
Do we have any models on those companies?
No, the thing is, we have models on most companies, but we don't model in the same way. So I would say we're not looking too much on the private companies. So I would have to get back on that question and kind of have a more thorough look.
Maybe it can be an interesting chart of the week topic. I don't know.
Yeah, maybe, but you can't really buy the share. So
no.
So that's kind of the equity research point of view. But yeah, you're from corporate finance, so
yeah.
I guess you have another view.
Yeah, can invest in those companies. Okay, so what is your take on the selling of its whole fleet by ADSC?
Yeah, okay. So I think ADS, when it was first put together, I think it was one of the most enticing investment cases I've seen in many years, kind of buying vintage assets and then installing scrubbers. It looked like a good idea at the moment, and no one could foresee that oil energy prices were to collapse from COVID-19. And then kind of trading them at least 2.5 years, and then divesting potentially, given the market at the time, and then but at least distributing all cash flow. So the whole point was you were not supposed to kind of, as always happens in shipping, you put up an entity and then you start hiring people and you start getting acquainted to the idea of having a shipping company. So the outset was really interesting, and I was really enticed by the whole idea. So, and then they hit the mark. It was perfectly timed, and they have earned a lot of money on those vintage vessels. But now I think it's quite binary. We have a net asset value per share of 26 Norwegian crowns. After the divestments, we have a net interest-bearing debt of minus 25 per Norwegian crown. So you have to turn the sign around. So basically, they have net cash of 25 Norwegian crowns per share after the sale. So the share price should be trading at 25, 26 Norwegian crowns if the market believed they will get the cash distributed, as was the original outset and the business strategy of the company. Obviously, the market is not that sure. The answer we will get 18th of November when they have their board meeting. And until then, I guess it's just a risk exercise. Will they get the cash, or will they use that cash to buy a more modern vessel and leave on? I think it's the probabilities of scenario A or B is best viewed in lieu of the share price.
Okay. Look forward to the 18th of November then.
Yeah, I think it's going to be
a
a very volatile day for the share price, definitely.
Yeah, probably. Okay, you probably saw this one coming. How do you see the U.S. elections affecting the shipping market?
Yeah. So I think what's the best for the markets in general, and also for shipping markets by extension, is if we get a clear election result, so there's no kind of ambiguity about who is going to lead the country. So that's the obvious one for the overall markets. Looking at the past 4 years, I don't believe the trade war has been very beneficial for shipping. So that's something I hope could be handled in a more, at least, transparent and predictable manner if Biden is elected. If Trump is elected, I expect more of the same, or even worse. Last period presidents tend to kind of, they don't have to think about re-election, so it takes away some of that constraint. But overall, I hope for a landslide victory for Biden, looking at the election through shipping market glasses.
Yeah. Okay.
And just a bit more specific, I think LNG and LPG look set to benefit if the trade war is scaled down. And we have seen, I believe, LG or LNG exports into China has improved over the past months. Also for dry bulk, we have soybeans, an important potential export good, going long distance from the US to China.
Yeah. Thank you. Okay, here's a new one that got 2 likes. Hunter Group has sold 2 VLCCs according to Clarksons. The sale still seems to be on subs. If the sale goes through, what do you expect will be done with the proceeds? Special dividend, buybacks? And what will become of Hunter Group going forward? Will they sell more vessels and wind down?
Yeah, so if we're still waiting for confirmation, so if they are on subs, I believe we might have to wait another 2 weeks, because Hunter Saga is right now entering the Indian Ocean, I believe, on its way to India. So it will most likely have to enter port to be inspected, so subs can be lifted. But if they are confirmed, I don't see any other assets Hunter Group would buy. These assets are kind of the best asset you can have out there. So then I would expect distribution to equity holders via special dividends or buybacks. But I don't expect Hunter Group to unwind completely going forward. I was actually surprised if it's confirmed, I was surprised they sold these 2 vessels. But it might be it could be an efficient way to kind of get away from that discount to NAV situation most oil tanker companies are in at the moment.
Okay, then we're excited to see that result as well.
Yeah.
We have much to look forward to.
It's always exciting times in shipping.
Okay, here's another question. Is the shutdown of Equinor's LNG plant a force majeure event, or will Equinor have to buy LNG from other sources to deliver to its customers?
Yeah, I believe it's a force majeure. I don't think I know anything more.
No.
I haven't checked, so I would, if I had my computer, I would Google it right now. But yeah. So I expect so. But it's nevertheless a negative event because the distances involved are quite long, and I still believe they have at least the Arctic Lady and one more carrier under charter. So I guess those two vessels will find other employment meanwhile.
Yeah. Okay. Let's see. Given the LNG demand boom towards mid-decade, should we expect an LNG sea ordering boom in 1 to 2 years?
Yes, I would expect so. If you recall the graph we had, we are forecasting for quite high ordering and deliveries of LNG carriers nevertheless. But if all these terminals come online, just to give you some background in our forecasting, we kind of, when you saw the graph we had under construction, those we believe 100% will come. We had feed process, I believe, I don't remember the number right now, but we have maybe 50% discount on those volumes. And then we have final investment or proposed, I believe, and those maybe 30% or 25% we have in our demand growth forecast. So, but still based on that demand growth forecast, we need a lot of vessels above our current forecast of vessels being contracted. So yeah, I believe when you make final investment decisions and start planning and constructing specific sites, I do believe orders will be placed at yards as well. So hopefully not one-to-one, and hopefully the projects will come online at the same time or prior to vessels being delivered. We kind of saw in 2007 and 2008 that all the Qatari projects were or delayed, but the LNG carriers are often kind of delivered with the key 12 o'clock on the specific date they agreed upon. So that destroyed the very thin spot market back then. And then we had the Yamal project, was it last year or 2009, where they kind of started up earlier and they didn't have the vessels, at least not ice classed vessels, and they did use the ones they had and did a ship-to-ship transfer outside. I think it was Kirkenes, and that created a lot of ton-mile demand because of the intricacy of that trade. So so it's at least it's always positive to get all those terminal potential expansion projects coming online.
We have a follow-up question on Biden here. Could Biden not be more favorable to Iran, which would increase the VLCC fleet?
Yeah, definitely. But it will also increase exports from Iran, both on crude and some products and then LPG. So I think net it will be positive.
Yes. Here's another one. Would you ever advise holding shares when your outlook is for a sector to have to go through a period of scrapping before it has a better outlook? Example, crude tankers.
No, I wouldn't, because scrapping is just such a small portion of the total equation. So if you were just relying on scrapping in isolation, I think you would use years and years to get through any trough. If you don't have a big spike in demand growth. So what we do is we see low order book. That's the main reason we expect low fleet growth in oil tankers and improving utilization from 2022. And scrapping is kind of seasoning on the plate, which enhances the total flavor. But no, I wouldn't look to scrapping in isolation.
Okay.
Let me just add, I forgot when we had the slide up that although we do kind of these predictions, short-term trends or potentially trading gains on oil tankers and then falling into third quarter, I would just highlight that doing those short-term predictions are highly uncertain. So any investors should be very or be aware of that big risk involved in doing such small trades.
Yeah, there's a person asking here if you have forecasts for LNG term charters in 21, 22.
No, it doesn't really say what terms either, but I would just, as a rule of thumb, if you're looking for 1 year term charters, I would basically use 1 year forward spot rate forecast. Maybe the last quarter or the quarter we're in, and then the next 3. I think that's the best fit historically, at least in other segments. But if you're looking toward 5-10 years, I would look to historical averages to kind of estimate the term rates.
This one is exciting, especially for me in corporate finance as well. Do you see institutional investor interest in shipping picking up?
I can't say I do. Unfortunately, I guess this is a good question, and that's what we're all waiting for. We have to keep in mind that we are operating in a segment which is really small, looking at the total universe of equities and bonds and so on. So we have a good example from earlier this year in oil tankers. So what we saw, and I got a lot of calls coming in, investors asking, these are investors not familiar with shipping, asking, should we buy oil tanker shares? Will this last? How long will it last? And are we kind of the last suckers to the party, or are we still upside? Sorry. And I think that's what we all are hoping for dry bulk these days. That at some point the generalist money will open their eyes, and then it takes kind of a small portion of their capital to really expand the market capitalization of the shipping sector and also the sub segments. And I think general investors are so fatigued of 10 years in shipping without any earnings. And a lot of the big names we speak with, they're kind of telling me, I can't take this to investment committee, because last time someone invested in dry bulk around 2014, that guy is not here anymore, and the investment committee will not even hear about it. So I think we will need to see shipping consistently returning or giving a return to equity holders by earning above cash break even for duration. So hopefully we could potentially, at least in dry bulk, show that in 2021 and 22, and can see a capital influx from 22 and 23. And when it happens, it's like that. That's then it's really elastic, and it moves fast.
Yeah. Okay. We're heading towards the end here. What is the lowest dollar per day cash break even for crude, product tankers, bulkers, and VLGC internationally in your coverage?
Okay.
Do you have that in your?
No, but it's kind of comparing apples and pears. So if you want the cash break even between the segments, I think for VLCCs around 24, VLGC around 22, Capesize around 16, and basically it's lower for the smaller vessel classes.
Yeah.
And for an LNG carrier, it's really very dependent on vessel type and your financing, but
Yep.
maybe 45 to 55 is the kind of range.
Okay. Yeah.
It's all in our reports,
Yeah,
so you can just download this one for free and see all the numbers.
Read the whole thing, then you'll find it. We'll leave it at that for that question.
Maybe last question.
Last question now. I think this one is interesting though. What would you say are the key risks to your bullish call on dry bulk?
Yeah, that's a good question. So I think Australian or ban on Australian coal imports, if it's prolonged, I think it's a big risk. It's like the last 2 years we have had 2 black swan events. So first we had the Vale dam collapse in January 2019, and then now we have COVID-19 kind of deteriorating. So as long as you don't see another black swan event.
Do you think the election could be
I don't think so.
No?
But obviously you never know.
No.
You never know. But with I think as long as you have that low order book, the all-time record low order book in terms of fleet, it's just inevitable before this market comes back into life. I argued the same before the dam collapse in Brazil, and I also argued the same last year. I don't see any reason to change that argument just because we have had a couple of black swan events.
No. This one is also a little bit interesting. Why not start an ETF or an investment fund that would follow your strategy and where retail investors could buy parts? Yeah.
So we have a lot of thoughts. Our research is obviously doing quite well. We are still ranked number 1 on Bloomberg, and that's based on our recommendations. That's globally. So how to best utilize that research platform? I'm always very happy when people are making money based on our advice. But it would also be nice to kind of have a vehicle where you put that strategy in place or for ourselves and invite investors in. So I can't really say too much, but we are thinking those thoughts, and I'm sure we will have, or if and when we have any news, we will make sure everyone is informed at the right time.
Indeed. Okay, should we have one last question? It keeps coming in more and more questions. It's really nice that they're so engaged, though.
Yes, I think we will have to do this more.
Would you like to do this one, perhaps?
You can decide. I don't see it as well.
Okay. What is the spread between eco, scrubber, and non-vessel rates, both Capesize and VLCCs, and how is that spread developing?
Yeah. Okay. So I think for the VLCCs, I think it's around $3,000 a day at the moment, and for Cape, I think the same number is around 1,600. So obviously that's much lower than we had expected, and the reason, or one of the reasons, is that the high sulfur fuel oil is highly correlated with the crude oil, so we kind of have dropped significantly this year, whereas the low sulfur fuel oil is at least in the amounts which has been made this year is basically just aimed at the shipping fleet. So you don't have that kind of volatility because the demand is not that different. So that means that the high sulfur fuel oil has fallen a lot in price, much more than the low sulfur. So then the question boils down to when you think crude oil prices will increase. I'm not into that part. I'll leave that to other analysts to decide. I think it seems like it's more politically driven by than by market fundamentals, but then at least you have the inputs, and then you can make your own informed analysis. Yeah,
I think we will leave it at that, and we'll just host another webinar soon instead. So save your questions for then, and then we thank you for watching, and hope you enjoyed it.
And we will distribute recordings and the presentation afterwards.
Okay, bye everyone. Thank you for watching.